Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. Home of the Canadian Insider Club, his website, CanadianInsider.com. Welcome back to the show.
Well, thanks for having me back, Jim, and thanks for everyone for tuning in.
The stock markets, of course, since the March major correction have been booming. Is this? Are there still opportunities, or have we peaked out yet?
At the very broad level, Jim, our indicators, our sentiment indicators are showing signs of market exhaustion, especially in the U.S. We're getting a basing pattern. What that means is sort of insider selling is kind of basing out here. 4 stocks with key insider selling for everyone with buying. You know, it's kind of basing, and that's often this basing pattern indicates, you know, a topping in the markets. You know, what it's kind of showing is that the momentum is starting to sort of fade away. There's not really a lot of additional selling opportunities, but not a lot of buying opportunities. But that being said, you know, for every 4 stocks where insiders may be selling, you know, there is one that's buying. So there are buying opportunities that are out there. So on the one hand, you know, on a very broad level, we're not all that excited right now, particularly in the U.S. market. And I think in Canada, we also have some cautious short-term, medium-term signs now. But at the stock level, we're in a nice environment that for insider signals, because we still have this inflationary impulse that the Fed, you know, today they're doubling down on their mission to get above 2% inflation. This is really good news, long-term, you know, medium to long-term good news, at least medium-term, you know, for the Canadian market, 2 years sort of outlook, at least 18 months. You know, this is very positive. So yes, you're going to get these, you know, pullbacks, overextensions, where the markets have to reset and pause. But with the Fed going for consumer price inflation, this is very good for Canadian equities. And it's also good for value investors in the U.S. because for a whole decade, the value investors just had to sit and watch technology stocks go up and up and up on the back of QE and low inflation and low bond yields, of course. Well, despite the little rally we've seen in the bonds today, and yes, you know, bonds will, you know, they will go through their strength periods as investors worry, will there be more stimulus and the like. Yes, you know, we're going to get these bouts of deflation worries. But so long as the overall trend for the next 2 years or so remains intact of more government intervention in the economy, and that's not necessarily something you know, investors may like, but you have to deal with what's being dealt to us. As long as we've got that kind of environment, you know, inflation should be supported. Yes, there's always a risk that inflation turns down, but you know what? You know, we're watching other indicators on that. We're looking at the gold-silver ratio. It's been sort of range-bound here since the start of Q4 last year. You know, it's been heading down towards sort of 70, but it's been stuck between 70 and 80, more or less. And we'd like to see it break below 70, because then silver would be outperforming gold, and that would be really pro-inflationary. You know, a next leg down, and you know, I think you'd be in the middle of another leg up in Canadian stocks and the value stocks at that point. So keep an eye on that. It's on CanadianInsider.com. We have the gold-silver ratio. I watch it every day, and but right now, unfortunately, it's not really doing much. It tries to go down, then it goes back up, but it's sort of stuck at the lower end of the range. So let's just see where that heads over the next few weeks.
We'll have more with Ted Dixon right after this.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ted Dixon. Ted, what's the big lesson from the Keystone XL project being canceled by President Biden?
Well, aside from it's never a good idea for a government to invest billions of dollars of taxpayers' money into private sector projects. Aside from that lesson, there is another lesson. This for the oil patch. I think that was a lesson for governments, but for investors, the progressive energy theme that we talked about a couple of shows back, looking at companies and organizations that offer solutions that fit within a public policy environment that's focused on reducing climate change is going to be really important. Okay, so what I mean by that, it's a bit of a mouthful, but basically, if you're in the energy area, if you're in the sort of transportation area, and your company, it does not fit in to helping reduce greenhouse gas emissions, if they're not part of the solution, and if they are not on board with that solution with full conviction, and I think that's really important, conviction as opposed to going through the motions, or just sort of getting there, or being behind the curve. You have to, companies that are there with conviction and are forward-looking, are progressive-looking, have a chance to deliver for shareholders. Companies that are behind the curve, can run into problems. And, now, TC Energy, they invest a lot of money in Keystone, but it doesn't look like it's going anywhere now that President Biden has canceled the permit. I just want to read, from a press release they issued November 17th, and it was on to highlight their sustainable long-term growth, okay? They're saying, looking forward, TC Energy is well positioned to capture significant additional growth opportunities that are expected to arise as the world both consumes more energy and transitions to a less carbon-intense energy mix. Okay, so they believe that they were well positioned to capitalize on growth opportunities, and, basically, a couple months later, one of their big projects get killed because the new president of the United States believes that their project would contribute to climate change, the XL pipeline. So what's the lesson there? The lesson there is, as much as TC Energy has adopted a philosophy of providing sustainable development, they were not forward enough. Like, they were not ahead of the curve enough. They were behind the curve for their size, for what they were trying to do. They may have thought, and I believe they were, had great intentions, they may have thought they were on track to look good and to contribute, but at the end of the day, it didn't take Joe Biden, 24 hours to kill their project. So, in hindsight, TC Energy likely should have gone to a net neutral carbon commitment on the project a year ago, not, January 2020 as opposed to January 2021. So it's, I think it's a lesson that, you have to be forward and you have to be ahead of the curve, especially if you're in the oil patch. We're doing our top energy report for January this week, and, we're going through our top ranked stocks in the list. And, some of them, don't yet have, even a sustainability report. And there's smaller ones and the like, and that's going to be harder and it's going to be more costly for those. I get that. But, the game is changing, and if you don't want to find yourself behind the curve, whether it's by a policymaker who decides they don't like what you're doing and they're going to close you down, essentially, or just on social media. We've seen the power of social media groups in the U.S., the last week or two with what's been going on, GameStop and the like, with the massive short squeezes. What if similar types of discussions start about, companies with their climate change approach. So, either good or bad. I'm not predicting that. I'm just saying, one cannot take for granted that what you're doing is enough. And, one always has to be, if you're in that space, I think if you want to be a leader, if you want to get the positive attention of investors, you got to be forward thinking. You got to be ahead of the curve. You not just have to be in a race to get the most barrels out of the ground at the lowest cost. You've got to also be in the race to establish yourself as the leader in the oil patch in ESG. And there's going to be a lot of people in the oil patch that don't want to hear that and don't like that. But, that's fine. Ignore, Ted, you don't know what you're talking about. You're just, a green lunatic. That's fine. See where being behind the 8 ball gets you in the oil patch on ESG over the next 5 years, and see if you are ahead, if you do establish yourself as a leader, see where your stock price goes, see how investors react. I think there's going to be huge divergence between those two, but, well, maybe time will prove me wrong. It wouldn't be the first time that I've been proved wrong on investing themes, but just looking at what happened at XL Energy, it was a big hit to the oil patch, and could it have been avoided had the XL pipeline gone to net zero a philosophy a year earlier? It's a moot point, but certainly doing it on the timeline that it was undertaken, which was in relatively short order before, and as far as I know. In terms of the press releases that I've looked at, now I may stand and be corrected, but, it happened within, a very short period of time after, before Joe Biden took office. And, you have to be well ahead of the curve on that area.
Biden is canceling oil and gas leases on federal land. Is that a new opportunity for Canadian oil and gas exports?
Well, sure. I mean, anything that ironically, and we've talked about that anything that Joe Biden does to restrict supply is positive for those companies in Canada that are producing, yes, and they have to get their products to market. I mean, we can get our products to market, just unfortunately, it's a very expensive way to do it. It's inefficient, using rail cars and the like. I mean, it's ridiculous, but that's the world we live in. And if Joe Biden is going to restrict, supply from the U.S., well, then that's a positive for us. Canceling the XL pipeline was a big negative, but, so you take as investors, you take what you're handed and the opportunities you're handed, but you certainly don't want to leave your company vulnerable to a Canadian regulator who signed an agreement perhaps with the U.S. saying, we're going to enforce, very strict carbon emission controls, and you're not ready for that. So that's it's a really interesting time, for companies to. It's an opportunity to establish leadership, and I think the capital markets, will be open to progressive companies that could come out with their story and say, look, we need more capital because we're going to be a leader in this area. But, I just think the idea that the old way of sort of saying, well, we're going to go and get some more money from the capital markets because we've got the lowest production costs in the oil patch, that may work, but we'll see. We'll see which, probably, a combination of the both for sure. You don't want to be in negative cash flow generating position either. But in terms of where we were a decade ago, where in the U.S. Capital markets were throwing money at negative cash flow producing shale companies that weren't doing anything really to climate change, but they were still able to keep the music going as long as the investment flows kept going. We will see. We will see where capital markets put their money over the next 10 years, but I suspect that there'll be a lot of effort by governments to encourage the flow to go into companies that are showing leadership in climate change. And, so that's, I think, something that's going to be a theme to watch over the next 5 years for sure.
Asia seems to have an insatiable appetite for natural gas because they want to stop using coal. Does Canada have to do more to get liquefied natural gas to Asia?
Well, I think we are working in the right direction on that. I mean, and we do have our challenges, but, we've been working on it. So that's a great opportunity as well. But again, just to get the pipeline built, which is in itself, to the West Coast, from eastern BC to northwestern BC, that's still, not a fait accompli. But there's going to have to be demonstrated commitment to carbon capture and greenhouse gas reduction technologies applied to that in the future. Because even if the pipeline gets built, 10 years from now, you don't know what the criteria will be for shippers receiving natural gas from source in terms of the amount of greenhouse gas emissions that are tagged to that source. So what I'm saying is, down the road, you want to be branded as a net neutral shipper of carbon, of natural gas. So you want to be able to say, when we produce this natural gas on the boat, we didn't create any extra carbon emissions for that. Okay, I mean that's the objective. That's the long-term mission. Okay, so that's really where we've got to be thinking if we want to have sustainable exports, to Asia. But yes, I think Asia is a great opportunity. We've seen natural gas prices fly. I believe power prices were at record levels in Japan this month. So there's plenty of opportunity there, and so for the naysayers that say no, there's no opportunity, natural gas prices aren't high enough, that's not correct. There's plenty of opportunity, but don't assume that just because you can get the natural gas onto the ship means that you're going to have a buyer for it at an attractive price in 5 years from now.
We'll have more with Ted Dixon right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, you said you'd like to insert an educational segment into our program. So the first thing you wanted to talk about was why insider holding levels are important, especially in junior mining.
Well, that's right, Jim. We've been doing insider tracking here at Inc. Research, for well over a decade, and still get a lot of questions about, how to interpret the data and how to use the data. Obviously, if you see insider buying, the natural reaction is, well, that's good. But there's a lot more. It's not necessarily always the case, by the way, but today I just want to focus on the role of insider holdings. That is the amount of stock that an insider, like a CEO, a director, an officer, holds and declares. You see, in Canada, you've got to declare not only whether you're buying or selling, but also how much stock you hold. And that gives you an idea of how much skin in the game an insider has. Okay, so that's across all the sectors. But why is it important, particularly in junior mining? Well, here's why. The junior mining industry, of course, is one that where promotion plays an important part, right? Because, you do have to generate excitement, for a project in between, the time you stake it and the time you build the mine. You have to keep investors interested. So promotion is part of the whole idea here of the industry. And there's a place for it. Okay. So, but what is really important though is how transparent the insiders are with the promotion and what they're doing with their own shares. And so I'm not going to mention the name of the company, but, it wasn't that long ago last year where there was a battery metals miner, and they got a very nice story written about them by a widely read news wire, and the stock went flying. Well, the insiders, sold a bunch of stock on that, but they reported it, and so I mean, those are the types of things that can happen, and that's part of the landscape of junior mining. Okay, but what you want to avoid, and this is where a real pitfall is I think, is that what I would call sort of the stealth promotions. Stealth meaning the stock's promoted higher and higher, and you don't see any insiders selling, and then one day everything just fizzles, and the stock goes down, and you wonder, well, what happened? Why was it doing so well? And then it just collapses, and the whole market's going up. Why is my stock not going up? Well, there's a real red flag that I think investors have to look for in junior mining, particularly right now that we're in a highly, I think, a promotional phase of the market where you're getting a lot of promotions. We've had a nice run here initially, but now we're seeing promotions really kick in to draw more people in to support stocks. So, various stock names. So, here's what you want to look for. You want to look for the significant declared insider holdings by the officers and directors, that they beneficially own for their account, where they're going to gain or feel the pain if they don't have it. Now, why is that? Well, because if they do not hold a significant amount of stock in their company, one has to ask what's going on, right? Like, especially in a junior mining company. Now, this afternoon I took a look at our database and looked at mining stocks in Canada under a $500 million market cap, and basically the median holding, by officers and directors, sort of as a group, was 5.7% of the shares outstanding. Okay, so that's just a rule of thumb. It's not a tripwire, but if the management team and directors do not own a significant part of the company at an early stage, right? You have to ask yourself why. And there are two key exemptions in insider reporting that investors should be aware of. One is what I call the household exemption, whereas, so if someone is a CEO of a mining company, they have to declare their holdings, but they can make the case that their wife, who does their own trading, or their son, or daughter, if they do their own trading, they don't have to report. Okay, and in Canada, so I think this is a big problem. But there's arguments for and against this rule, but it is what it is. So we have to deal with it. And so you can think of a case where of a big mining company, and Jane is his wife, and they're having breakfast, and Jim says, "Gee, if I owned a lot of stock in this company, in my company, I don't know if I'd be holding on to it right now, And so is he like telling his wife to sell? No, I mean, he doesn't have to say anything, right? And it's like, okay, well then Jane goes and sells her shares. But you go to the insider reports and you don't see Jim doing anything with his 2,000 shares that he's got reported. But, somebody is making off like a bandit. And, so, it's very hard for regulators to catch that kind of activity. Is it impossible? No. But have I seen examples, a lot of examples of that happening? No. Of insiders, of regulators enforcing that. So how do you avoid that? Well, you look first, and you look to see how much does the CEO own in actual shares. I'm not talking about options. I'm not talking about rights or any of that stuff. I'm talking about shares. Okay. So that's one reason why. And the other reason why is in Canada, there's a 20% exemption. A 20% rule where if you own 20% of the stock or more, you have to report. But if you're under that, you don't have to report. In the U.S., it's 10%. So you can have a lot of major shareholders who just fly under the radar screen, who who have interest in the company, and you don't know. Maybe they're related in some way, indirectly, to some of the principals in the company. You don't know, right? And you won't know. So, but again, if the insiders have a declared large amount of holdings in the company, then, those other investors flying under the radar screen, you don't have to worry as much. I don't say you do not have to worry at all, but but it's not the same type of, the management only own, 0.1% of all the stock. Who owns all the rest, right? Well, if management owns 10% of the stock, then, you don't have to be quite as worried about who owns the rest. Sure, there's still 90% left. But, with at least the insiders, the management team, the directors, do have a fair amount of skin in the game. If they don't have any skin in the game, somebody has skin in the game somewhere, right? You don't just have these junior mining companies floating around with, unless they're trading at a half cent and trade, 500 shares a week. But, if any mining company, junior mining company, is trading decent volume, decent levels, and you've got very little management and director declared insider holdings, it's a red flag. Now, it's not a guarantee of success. If they do have strong holdings, right, doesn't mean that, you're going to make out like a bandit. On the upside, if there's 10% management holdings, that's not what I'm saying. What I'm saying is if they don't have significant holdings, you really want to kind of do extra due diligence on that company and find out, why, and ask them, why don't you own more of your shares, right? And, this is such a great project, these are such great assets, why do you only own, 50,000 shares of this great mining company, Mr. CEO? If you've got this great presentation on your website, how come you're not loaded up, right? So you do want to look at that. We do have, reports in PDF format for people who are not subscribers to Inc. Research on King Insider. It's not very much to pull one off. You can buy them per report, or you can go to SETI. It's free, right? And you can look it up. So so really take a look at the holdings for these mining companies and make sure that the management teams have significant skin in the game. That's just sort of part of the due diligence. It's not a guarantee for success, as I say, but if they don't have significant skin in the game, you really want to do a bit more digging as to what's going on in that particular entity.
Ted, thank you so much for chatting with us.
Well, thanks for having me back, Jim.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, his website, CanadianInsider.com. If you have any questions for Ted or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.